Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for January 14th of 2024. Well, I hope all of you have had a wonderful week. As we get started here in 2024, I want to spend a little bit of time on inflation, as we do from time to time. We did get the December CPI numbers this past week, Consumer Price Index, and want to reflect a little bit on where we've been and maybe a little bit on where we seem to be going. So in this chart, this slide rather, we've got two charts. On the left-hand side, we have annual inflation rates going back to 2013. You can see very clearly a well-established trend that existed before the pandemic here. You can see, we had several years of very outsized inflation, but it was coming down ever so slightly. And this past year, we saw a lot of progress on inflation. So including the December numbers, the annual rate was 3.4%. And then on the right-hand side, you can see really what I'll call a tale of two cities. So, when we had the onset of the pandemic, there was a lot of goods-related inflation, which led to a lot of manufacturing choke points, supply chain problems, et cetera, which drove, inflation up quite a bit. Well, we started to see service-related inflation assert itself around the same time, but it was much more subdued than this kind of cathartic event here. Well, subsequently, as you can see very clearly here, goods inflation has really gone down, and we're almost flatline on goods inflation. But services inflation, as we talk about where the CPI is now at 3.4%, a lot of that has to do with services. And a lot of that is going to be inherently sticky to get rid of. When we talk about the stickier components of inflation, we've got rents and we have wages in that number as well. And so as we talk about in the next few slides, kind of where that sits, there's certain elements of inflation that are clearly moving in the right way, and some elements that I think are going to take a little while to come down. As we'll see here, I do think it is going to give the Fed a little bit more pause on lowering rates. And I think there's a lot of optimism heading into 2024 that we're going to get 250 basis points or 2.5% of rate cuts, and we're going to get like 5 to 6 rate decreases starting in March. And I just think that's a bit optimistic, given the fact that we are some measure away from the target. And even though inflation is clearly coming down, there's sticky elements that I think will just take a while to kind of work their way through. Here we have in this chart the actual data that we did get last week. And so we can see the overall CPI was up 3.4%. That's an annualized change based on December. So you also saw that number in the last chart as well. And you can see here, core is still almost 4%. So when you think core, it backs up, it backs out, I should say, food and energy. And so that's been running a little bit hotter, although directionally both have been coming down. I think the surprise was that we saw a little bit of uptick here in the most recent reading, which was, a bit of a surprise. And it was just a reminder, again, that inflation coming down is going to take a little while. This is a chart with what we'll call the super core consumer price index. And so just to be clear, this is a very nuanced number. Almost you call it a subcomponent of the whole index, but it's core services. So, core excluding food and energy, but the service inflation less housing on a month-over-month basis. And so this does take out quite a bit of noise, but you can see here that over the last couple of years, running much hotter than we have been during the last decade. And so we did have a slight downtick in this overall number last quarter, but in the aggregate, you can still see that it's trending higher overall. It's a chart from FS Investments looking at things from a different perspective. We've just got through talking a little bit about CPI, and so you see that basically in the gray and the orange numbers. but it also includes personal consumption expenditures and the deflator, essentially the number that we're looking at to get the gauge of inflation that the Fed looks at. And you can see that all of those are trending in a very similar manner. You can see that, for the most part, PCE, as it were, tends to fall below the CPI numbers. So again, that's what the Fed looks at. And you can see here, basically during, 2022, there was a fairly wide gap. Now that gap is narrowed quite a bit. You can see where that's falling in line here, that we're, running about, 3 to 3.5%. And obviously that's where we ended at the CPI this past year. One thing to consider, though, is that if you were to take the last 3 months only and then annualize that inflation number is actually looking much lower. And that inflation number, that near-term trend, if you will, is actually very close to the Fed's target right now. So we are making progress. I want to be clear. This is a chart of expectations looking out both 1 and 3 years. You can see here that the expectation is for continued decreases as we look out into the end of 2024, as well as, we basically look out into the beginning of 2027. And so you can see over 3 years, that number's looking, not quite 2%, but kind of in a 2.75, maybe 2.5% range. And then over the next year, looking for inflation to fall to 3. And so if you actually believe this, then you're less inclined to assume that the Fed's going to drop rates as much as people are expecting, and they're going to do it as soon as they're expecting, because this is still not at the 2% target that the Fed's aspiring to. So I wanted to spend a minute on this, and so we go back to, go back in time, look at the 1940s, look at the 1970s, and we can see multiple instances where, we went and waged war against inflation and brought inflation back down. But in both of these instances, we actually had a resurgence in inflation, which prompted a more visceral response from the Fed. And, you think about the 1970s in particular, we had, in the late 70s, and not necessarily tied directly to, a spike in oil prices from the 1973 embargo, but from a lot of other things, we had this rise in inflation. The Fed got serious, and then, then we saw double-digit, rates and very aggressive rate tightening by the Fed. Well, this is what we want to guard against. We want to guard against this resurgence, and so we're here in this red right now, and so we've got inflation that spikes coming down. We just want to prevent this from ticking back up again, and so that's why the Fed's being very careful, and that's why I think it's kind of a fool's exercise to some degree right now to assume that we're going to get all these rate decreases, because what that could do is lead to this very undesirable spike and a resurgence in inflation. A couple charts here. We have, I think a tangible risk of some inflation that may creep back into the manufacturing sector at a time where manufacturing here domestically is kind of coming out of its manufacturing recession, its rolling recession, if you will. So, very clearly we got the rebels in Yemen, the Houthi rebels in Yemen that are wreaking havoc on trade and trade moving through the Red Sea. You can see here that in the in the Middle East, that we've had a huge drop-off in daily transit volumes. As a result, costs are increasing because they're having to take longer routes, and so we're beginning to see an uptick in container prices again after having witnessed a fairly dramatic fall over the last couple of years. All this to say that input costs for shipping are likely to move higher for the time being. This may or may not be sticky, but it's obviously something we want to pay attention to. These are costs that get pulled into the production sector, and then ultimately can drive producer inflation a little bit higher. Something else that we're looking at too, very clearly with regard to shipping, is the Panama Canal, and not many people are talking about this. If you look at total trade in the Red Sea, that's about 15% of trade. Panama Canal, maybe I think 5% in a very rough way. But you can see daily volume going down there because we've got low lake levels in that Panama Canal channel. And so the water that supports those locks is well below its usual amount here. And as a result, they're not able to get as many container ships through. These are big ships. They're very heavy. They require a tremendous amount of buoyancy. And when you don't have enough water, it makes it a little hard. So the volume there is going down. So that's contributing to prices as well. And you can see this in this chart from B of A Global Investment Strategy. Rates are once again spiking. So, we have that. And again, just more risk of producer-induced inflation or producer-resident inflation. So as I mentioned before, service inflation is pretty high. You can see, on the core goods side, this is a chart that I just showed you. So service inflation there. And then if you look at core services, excluding shelter, it remains fairly high. And we know shelter is high in and of itself. But you can see the annualized rate, really heading into the end of the year was trending higher, and that's something that we want to monitor. Again, this is not a scenario that you would, expect to be the genesis of a rate easing discussion. If anything, you'd be probably on guard to potentially raise rates. But I think that's definitely a component of overall inflation that has everyone's interest at this point. Wages and prices, I've talked about a little bit already. I've shown you various charts on that over the last several months. So as we look at wages in general, you can see a downtrend, but the overall 12-month or year-over-year price change is still around 4%. So as we know, that's higher than the overall rate of inflation. So wages are growing faster than inflation, which means that real wages are increasing, which is good for consumers and workers because real wage growth is a sense of, is a source of confidence, if you will, and it's gives people a sense of confidence in their consumption patterns if their real wages are growing. But we do see that coming down, but that is kind of plateauing for the time being. Interesting chart that I found. This is the National Federation of Independent Business, as reported by Oxford Economics, and you can see, two data series being plotted here that have a very high correlation. So you can see plans to raise compensation. This is on a 6-month lead basis, and so you can see in that red line that, we're generally speaking, we've got an uptick, and we've had an uptick over the last, call it the last decade. And so briefly interrupted by the pandemic, briefly interrupted by, maybe high outsized inflation, but then that number is going back up again. So this is an indication of future wage increases. And then you also have the ECI, which is the Employment Cost Index for private industry wages, that is following the same pattern, although this is on a lead basis, so you expect ECI or employment costs to go back up. And so, this ties back to earnings for companies. If your wages are going up, and wages are an important part of your cost structure as a company, then, that might have an adverse impact on your margins and your ability to grow your earnings to some degree. And so, we're watching wages as one thing that could be a fly in the ointment there for earnings growth, which we'll talk about a little bit later on here. But again, just keeping our eye on this. Here we have shelter and rent inflation, and this is one of the biggest disconnects in economics right now. Is what we see in core, what we see in shelter inflation and what we see in observed rent trends, you can see a very tight relationship here overall. And so this is a new tenant rental index. So you can see that we've really rolled over. So that's not to say that rents are negative. They're just growing a lot slower. But the rents that are reflected in CPI, which is in this blue line, have yet to roll over. We haven't seen that tie-in yet. So we've got a pretty big delta, which I think will narrow over time. And so as you think about shelter inflation or rents as a part of the consumer price index, and on the core CPI, it's actually closer to 40% shelter is, and so I do think that this is going to have a positive impact on the downward trend or the disinflationary trend for inflation during the coming months. I want to talk about economic growth for a little bit. This is data from the World Bank, just got released in their 2024 outlook, and you can see, these shaded bars looking at different constituencies. Global economic growth expected to drop again for the third consecutive year, and following basically 2021, which is a rebound year. So obviously 2020 was negative related to, or it was very minimally positive related to the pandemic. But slowing growth, in the U.S., we had a very good year, relatively speaking. We'll get more data on December and for the balance of the year. But it's going to be a better year than it was last year, but we're looking for a little bit slower growth in 2024. Eurozone, fairly weak year, but picking up a little bit next year. And then China, which, for its purposes, posting anything below a 6% rate of growth is, for its size of economy, is really kind of almost a negative implication there for China. On this chart, we're talking about economic growth looking at a year. This is from some Goldman Sachs research from their team. The consensus estimate for economic growth next year, as we saw on the previous chart, is a little bit less than 1%. So folks are anticipating positive yet slow growth. So that does not imply, necessarily a recession, which is over here on this side. You look at the Bloomberg consensus probability of recession as you look, November coming into the first half of 2023 was, much higher, above 60, like closer to 65%. Now that Bloomberg consensus probability of recession is around 50%. Goldman, for its part, is much lower. It just shows you that there's a wide gulf between, where that consensus is in this general time or this general range, and that you do have some firms that are much more optimistic, and then you've got, let's say, J.P. Morgan on the other side, who is probably closer to 60 to 70% on their probability. But you can see, and this is driven. This gap here is driven by the fact that Goldman expects much stronger economic growth this year, to the tune of a full percentage point, and even the Federal Open Market Committee, the Federal Reserve, essentially is looking for about 1.5%. So there is a wide gulf of opinion with regard to what economic growth is going to look like this current year, and that has a large bearing on your feelings as far as risk of recession is concerned. Thought this chart was interesting as we were talking about recession risks and whatnot, but you can see that search term that Google searches using recession as a search term have really gone down. We look at key themes for the current year. This is from J.P. Morgan. So as you look at, we look at 2020, obviously it was the pandemic, and then supply chain constraints, which really took center stage here in 2021 and 2022. We also saw that inflation was a big bugaboo and occupied our conscience quite a bit. You can see the downslope overall in the pandemic conversation. And then where we are today, again, some of these mentions and transcripts of earnings calls for the Russell 3000. A lot less mention overall for these topics, but of the four topics that are mentioned here, the one that still has plenty of traction is supply chain, even though it's well below prior years. But when you think about an order of priority, obviously pandemic is below the other three, but artificial intelligence, you can see a general upslope here. So I suspect we get into 2024. The key themes will certainly be AI. We'll probably hear maybe a little bit more supply chain, just because we've got shipping constraints now related to the Middle East and Panama. And inflation. It'll be interesting to see where inflation lands in terms of the key themes here in 2024. So on this slide, we talk about market expectations for interest rates with the inflation rhetoric as a backdrop. And you can see here very clearly that the market for a while has been expecting rate cuts. And so these represent kind of forward expectations at every monthly increment. And so, for a while in 22, market was clearly expecting more increase in rates, but then we hit a point where the market started to price in rate decreases. And so, right now we're looking at something that's fairly aggressive. If you are looking at the current inflation data, and then and this is from FS Research, and they do a great job up in Philadelphia here. And their point was there's only been one example where we've had rate cuts without a recession, and this is where we are now. This is the rate expectation for 2024, and then we're going to get basically, we're going to go from essentially 5.25%, 5.5%, all the way down to around 4%. And some people are looking for even more than that. However, and in all of these prior times, there was a recession involved. And so, again, the consensus is not expecting a recession now. Is there a risk of it? Yes, of course. But this is what the market expects. And so this is what the kind of like the balance that we don't want to disturb. If there's a negative surprise with regard to inflation information, or if there's something that provides kind of a shock to inflation that's unanticipated, it could add a lot of volatility to the market, at least on a near-term basis. Spend a few minutes on the consumer here. We've got two measures of consumer attitudes. One is from the Conference Board, their official Consumer Confidence Index, and the other one is University of Michigan's Consumer Sentiment Index. And together they paint a somewhat similar story here, that we are at levels of confidence and sentiment that are, both of these are pre-pandemic levels, and you can see where we are today, and we're below those levels. And so we've had this downward trajectory in both of these measures following the pandemic here. And so, but what's clear though is that the consumer continues to spend, and we feel like they continue to spend out of their savings. They're finding means to do that, and as we just mentioned a few minutes ago, real wages are rising, and so that does help to support confidence, and it does help to support consumption, but it's clear that those confidence and sentiment levels are below where they were prior to the pandemic. Got more data on the consumer here. We have household net worth. Over here, you can see overall that household net worth has gone up. And of course, that gives people more confidence to go out and spend. And so as you look at this dot plot here, household net worth to personal savings rates, it's not too surprising when you have higher net worth that you draw down your savings because you're confident. It adds a little bit more confidence here. But even though the surveys that we just looked at are below pre-pandemic levels, they're at levels that are still able to support consumption and drawing down your savings rates. We talk about the consumer, we have to talk about credit and delinquencies. Here we've got delinquency rates for credit card borrowers from the highest income quartile to the lowest income quartile. You can see they're all moving in an upward trajectory. Some of this is perhaps normalization. In some respects, you've got levels that aren't entirely dissimilar to pre-pandemic levels. You can see here as you get down the income tiers that you're seeing levels that are kind of outpacing where they were before the pandemic. And over here we have kind of a breakdown in delinquencies for auto loans. And we've got in the blue line, these are for subprime. So subprime borrowers are witnessing more delinquencies right now. They have, again, this data goes back to 2006, and so this is inherently cyclical. Ironically, we had subprime borrowers that were witnessing incrementally more delinquencies even before we got to the pandemic. And then, as we look at prime auto loans here, they're even moving up as well, but they're basically in a line that was consistent with pre-pandemic levels. Here we have interest rates being charged on credit cards by commercial banks. We know that that's moving higher. It's an opportunity source for more income from the banking sector to charge you more on your interest for the credit card balances that you maintain. And you can see delinquency rates on credit cards by vintage year moving up considerably higher for 2020, but you can see here even in 2022, just as we saw a few slides ago, that that's moving up as well. Labor market tightness. We talk a lot about labor and the fact that it's been strong, maybe showing a little bit of weakness, but still maintaining unemployment rates that are well below where we thought they were going to be and fairly close to multi-decade lows. And you can see the overall trend regardless of what measure you use, whether it's the job openings or the quits rate here, you got the Conference Board labor market index, you got the National Federation of Independent Business, and you've got all these different measures, and they tell a very similar story. As we worked our way up into a very tight labor market that has eased up ever so slightly, but it's still in many ways consistent with what the environment was before the pandemic. But we do see labor market tightness easing up just a little bit, as we have some companies out there that are kind of slow pedaling hiring decisions. So I want to talk about where the labor market is strong and maybe where it's less strong. This is not necessarily a source of worry. It's just kind of an interesting reflection on where things are right now. And so, if you go back to about the third quarter of 2022, we saw an inflection point here. And so, you look at this solid blue line here, and it's monthly payroll growth for everything other than healthcare, government, and then leisure and hospitality. And you can see that that number continuing to move down, and to a point now where we look on a 3-month average, it's fairly anemic. But where we're seeing hiring and where we have consistently seen hiring here is in the healthcare, government, and leisure and hospitality sector. So when you talk about healthcare, you're talking about fairly strong wages. Government, not as much, and then leisure and hospitality, you're dealing with more kind of the semi-skilled level. And so, but as we have more demand for experiences, more demand for travel and leisure and et cetera, that we're still seeing consistent growth in this sliver of the economy. Talk about business sentiment for a second. We also have, some weak measures. I mean, what's interesting is that, a lot of these surveys are kind of a self-reflection. What are you optimistic about your own prospects versus the rest of the economy? A lot of CEOs are optimistic about the economy as a whole, but a little bit more guarded on their own prospects. And you see here we want to talk about small business, which represents the lion's share of overall commerce in this country. The National Federation of Independent Business Small Business Survey remains fairly weak. And then as we look at, sentiment surveys, this is the ISM, the Institute for Supply Management. In the orange here, we've got the manufacturing sector survey, and that's actually below 50, which means that it is, for all intents and purposes, in a contraction. We do know that manufacturing has been in a bit of a rolling recession for a little bit now. And then here's the non-manufacturing, which is straddling that 50 range right now. So these sentiment surveys have gone down. So if you're, a little bit more bearish on the economy, you look at this and you say, all right, well, sentiment is fairly weak. And sometimes you get this translating into action. Sentiment eventually results in, what companies decide to do. And so this is the fear that, when you're balancing out all these other things in the economy, obviously you want to have a vibrant business sector. And, you don't want to raise rates or keep rates too high for longer, because that will choke off business growth. And we do know that lenders are tightening, and we've got a chart on that. But, you want to make the credit, as hospitable as you can without inciting inflation. I think that's the Fed's tough job right now, considering that business sentiment is a little bit in flux right now. So here we have the financial balance of U.S. business, and this is basically the difference between income and expenses. And what's interesting here, in light of the sentiment surveys that we just looked at, that overall companies are in pretty decent shape. On a time series that goes back to, or data series goes back to 1990, we're actually in really good stead. Maybe not so much after we came out of the global financial crisis and we saw kind of a gradual downtick, and we're at levels that are below that. But if you go back prior to the GFC, we're seeing overall financial balances that are fairly conducive for both non-financial corporates and non-financial unincorporated or private businesses. Let's talk about bankruptcies for a second. We have this data series going all the way back to 2007, global financial crisis, and saw this downtick. And then, during the pandemic, we had, a spike in bankruptcies for companies for large companies, with liabilities more than 50 million. But that's gone down, and we have seen an uptick, and I've highlighted this to you in the past. But I think a lot of these charts that I've shown you on bankruptcies have only gone back to, like 2018, 2019. And what's, I think, really interesting here is that, we still remain relatively low compared with history with regard to bankruptcies. Even if they have picked up a little bit, the overall backdrop is certainly not bleak at this juncture. I mentioned slower loan growth. We're definitely seeing that out there, and then and the sentiment is actually for tighter credit as well. And I've kind of shown you these data series separately, but it's nice that FS puts this on one chart for us, because you can see the really tight correlation here on these two data series. You've got C&I annualized loan growth, year-over-year loan growth in the white, and you can see that where the pandemic dislocated that. But then, we see overall loan growth actually, if you look at the left-hand scale, we're actually in negative territory. So year over year, we're seeing lower loan volumes. And then this orange line here represents the banks, percentage of banks that are tightening their lending standards. And on the right-hand scale, you can see that number, this is an inverted scale here. So, see that the number of banks is much higher than it was, really just a short time ago. And if you look at cyclically, banks tend to be, easier on credit than they are tighter on credit, but they're clearly tight on credit right now. So as we continue the conversation about credit, it is helpful to know that every coin has a flip side, and so the interesting flip side now is to the tight credit situation amongst commercial banks is the emergence of the non-bank sector. And you can see, both non-banks and the commercial banking sector have seen a decline or a decrease in the number of small business loans. But that decrease has been far less on the non-bank sector. These are much more expensive loans than you get from a commercial bank, but you can see that that non-banks are filling a void here. And you think about non-banks, what does that mean? That means like, private credit and entities that have raised capital to make direct loans to small and medium-sized businesses that are outside the banking sector. And so, that sector remains much stronger in terms of its willingness to extend credit, even at higher rates, than does the commercial banking sector. And over on the right-hand side, we look at the SLOOS data. This is the Senior Loan Officer Surveys and optimism surveys, if you will. So SLOOS, net percent of banks reporting tightening. And so that number, as we just saw in the prior slide, remains relatively high. And but again, going back here to the point that non-banks are, even though the volume may have gone down, it's still much more plentiful credit to receive than to obtain, I should say, than from a commercial sector. You see that number is actually not that bad. So National Federation of Independent Business share of small businesses that said that credit was hard to get is not what you think it is just by looking at the SLOOS data, because you've got non-banks that are participating in that space. I want to talk for a minute about commercial real estate and its relative importance on the overall economy. We've talked a little bit about some of the debt maturity issues that a lot of commercial real estate owners have in rolling their loans, some of the potential defaults because offices remain so weak. And we'll first talk about prices and values. And pretty interesting data here from Goldman Sachs. As you can see, office here remains pretty weak. We've seen a consistent erosion in values as we've seen higher interest rates move higher. What's really interesting is retail values have actually gone up amidst a stronger consumer. We've been talking for at least a year about the strength in industrial, which is well above its prior year levels. And even though it's off its peak, it's still at a pretty high point. But if we look overall, we say, all right, what's the stress that might be coming from the office sector in terms of debt maturity rollovers and things like that? If we look at large banks, it's measured. If we look at regional banks, which, we were talking a lot about 9 months ago, it's not as much as you would think. So is it important? Yes. Is it cataclysmically impactful? And I guess the answer is no. The impact on GDP overall is actually not that much. So I think there is some impact for defaults from real estate loans that are tied to office that are going to have to be rolled in the next couple of years. But is it going to be really an issue for the economy? I'd say the answer is probably no. Talk about private equity for a little bit. We've already mentioned private credit, kind of filling the void of the banking sector, providing loans to middle market companies. And private equity here, we see that fundamentals remain fairly strong. We have, forecasted activity. This is from FS Investments, still looking fairly strong. And as we look at private equity as an asset class, we see that there's historical outperformance relative to the S&P 500, and in a market that may have some mixed blessings this year that would eventually, probably turn north next year. I'd say, the ability to use private equity as a diversification tool and as a source of incremental return is actually fairly strong. A couple other things before we kind of get into the equity market a little bit. We've got lumber prices that are coming down. As we look here, we're down now, I'd say probably closer to about $350 per thousand board feet. We saw a lot of stress in the markets over the last couple of years, and we're basically down to longer term averages. And so it's good for home builders, good for the commodity basket. We do see things like iron ore prices coming down, and so commodity basket, which by and large has been trending lower over the last year, is still looks to be trending lower here heading into the first part of 2024. Quick couple of charts here on oil, on the oil market. What's really interesting here is that rig counts remain, I think, somewhat sluggish from points that we saw, between 2010 and 2015, but yet production remains really strong. And I think, to the degree that, this type of, 13 million barrels a day can be sustained to some degree without having to, ramp up our rig count. That's going to help keep a lid on oil prices, and then as a result on energy prices, and the ability to generate a lot more production from domestic sources takes, in fact, some political pressure off the table from OPEC and OPEC Plus. They're trying to manipulate those prices. Here we have kind of the rule of 20. This is from Liz Ann Saunders at Schwab. And so if you add the S&P 500 price to earnings index ratio to the overall U.S. consumer price index inflation, so basically if you're adding the multiple of the market to inflation, and if you can keep it below 20, that tends to be better for the stock market. And right now, that number's close to 26, again, adding those two things together. And so, by this definition, maybe the market is due for a little bit of a pause, maybe a little bit of volatility. You can see that, these are basically in 5-year increments. And, for much of the last, call it 15 years, we were in attractive categories. And, right now we're above the longer term averages, perhaps. So, could the market move down around 5 to 8% at some point? Probably. So anyway, that's something that we're also watching. It's kind of a little bit less often used indicator, but it is interesting nonetheless. Here we have a couple of indicators. On the one hand side, we've got the American Association of Individual Investors. Individual investors coming out of 2023, really optimistic. Well, and over here we've got more of the institutional sentiment. So this is individual investors, this is institutional investors, and they're also pretty optimistic. So they're holding net weighting in equities is fairly strong. And so that's where we are. Optimism levels relatively high, volatility levels relatively low heading into the new year. And so we'll take a look at maybe the implications of that here on the next slide. So this is a slide I was talking about. So when you come into a year and you have high levels of optimism, high levels of equity positioning because you're extremely bullish, you tend to have more of a capped upside, and that's what's reflected in this red box here. So just on the converse side of this, if you have low sentiment, low positioning, you're not very bullish. Oftentimes you have outsized performance because you're certainly expecting, relatively unrewarding things to happen, and sometimes you actually get rewarded for that. And but then, sometimes when you're overly bearish, sometimes it is a self-fulfilling prophecy, and you get larger drawdowns. But when you come in high levels of positioning, which is where we are now, high levels of optimism heading into the year, you tend to have less downside risk. Your drawdowns tend to be less, even though your upside might be capped, which again, if you're looking at, the possibility of having, having the next, 12 months be somewhere around, 5 to 10%, that's actually not bad. If you look at, the average max upside over the next 12 months coming into a year like we're coming in now, of maybe around 10 to maybe almost 15%, that's not bad. So I would actually prefer this scenario than something that may have a little bit more volatility to it, because we're trying to cap our downside, and we're willing to give up a little bit of the upside to get that downside support level. So this is a chart with S&P 500 quarterly earnings, actually to be more precise, net profit margins. And so what we're looking at here in the fourth quarter is the expectation that profit margins are going to drop, but then they're going to reaccelerate. This is a bottom-up consensus of estimates out there for 2024. So, and this actually translates into increased earnings as well. So the earnings estimates looking out into next year are looking for about a 10 to 12% upside in earnings, with 4Q here being the trough. And we are literally going to start to get reports on fourth quarter earnings here in the coming week or weeks, and we're going to see if this kind of transition is actually playing out. But right now, just to be clear, the expectation is for positive margins and earnings experience heading into the bulk of 2024. Here's a quick chart on Brent crude. This is going back to our earlier slide. You can see the downtrend over the bulk of 2023. We seem to be finding some stabilization around $80 a barrel for Brent crude. Again, some of that has to do with what I mentioned, that we're getting more domestic production, which, despite the efforts of OPEC Plus to try to control pricing, we're still seeing a little bit of depressed pricing, even despite the Gaza conflict and some of the Middle Eastern issues that we've been talking about. Something I thought was very interesting that could increase the cost to global business is the issues related to catastrophic losses that are insured by very large global insurance and reinsurance companies. So we see here in this chart from BlackRock that the number of catastrophic events has certainly gone up over time, and the total cost has also gone up. So these are inflation-adjusted losses of over $1 billion dating back to 1985, and you can see that these catastrophic events are becoming much more prevalent. You can see, global insured losses due to extreme weather has also picked up. Now, this is not a comment about global warming or anything like that. It's just a recognition that there's a higher occurrence of these things that are providing greater cost to insurers that are insuring these risks. And you can obviously see that profits are going very much into the red. And so what this is going to result in is, higher costs, higher premiums, which in turn are going to create higher costs overall for, for everyone along the business food chain here. That will do it for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon. Bye.